There's a metal silently positioning itself to crack the global economy. Every rooftop solar panel, every electric vehicle rolling out of a factory, every 5G tower is rising across the world. They all depend on one thing: silver. And we're not running out in 50 years or 10 years. We're running out right now. In the next few minutes, I'm going to reveal a four-stage pattern that is repeated in every major commodity crisis. The oil shock of the 1970s, the wheat collapse during the Irish famine, the palladium spike in the early 2000s. And I'll show you, with data anyone can verify, that silver has just crossed into stage 3, the point where the outcome becomes mathematically unavoidable. Let's begin with the numbers every government should be terrified of. Global exchange inventories, down 60% in just 4 years. Solar demand by 2026, over 200 million ounces, up from only 85 million in 2020. And here's the part that makes this crisis unlike anything you've heard before. This isn't a slight increase in demand. This is a surge. Industrial consumption is doubling in under a decade, while supply hasn't moved at all. But silver's true danger lies in its dual identity. It isn't just an industrial metal, it's money. For 5,000 years, it has been the only material trusted both as a critical industrial input and as a monetary metal backed by centuries of belief. When a resource holds both roles simultaneously, a shortage doesn't trigger a price jump. It triggers a system shock. When exploding demand hits a monetary system built on infinite debt, you don't get a price adjustment, you get panic. Now, before you think this is clickbait, let me be clear. This is not a prediction. This is pattern recognition. There's a four-stage mechanism that governs every commodity supercycle in history. Silver is now in stage 3. The outcome isn't uncertain. It's mathematically inevitable. Here's how it works. Stage 1. Abundant supply creates complacency. The resource is cheap and available. No one explores for more. The system assumes supply always meets demand. Stage 2. Demand surges, but supply can't respond. A new use case emerges: solar, electric vehicles. Mining takes years, decades to expand. Geology doesn't care about forecasts. Prices rise slowly at first. Stage 3. Recognition of structural deficit. Markets realize supply won't catch up. Inventories drain. Shortages appear. Paper markets lose control. We are here right now. Stage 4. Price dislocation and panic. Governments stockpile. Industries hoard. The price doesn't rise. It detonates. I'm going to prove this pattern to you 3 times using 3 completely different historical moments. And when you see it, you can't unsee it. Oil. The 1970s. Stage 1, 1945 to 1970. Oil was cheap. $3 a barrel. 30 cents for gas. The entire post-war boom assumed infinite cheap energy. Stage 2, demand exploded. Europe rebuilt. Suburbanization, car ownership soared. But U.S. oil production peaked in 1970. America became a net importer. New supply years away. The North Sea wouldn't come online until the late 70s. Stage 3. October 1973. Yom Kippur War. OPEC embargo. Oil prices quadrupled in weeks. Not just the embargo, it was the brutal realization that cheap energy was over. Gas lines formed. Production slowed. Stage 4. Oil went from $3 to $35 a barrel by 1980, 10 times in a decade. Inflation ravaged economies. Central banks lost control. Pattern confirmed wheat. Irish potato famine, 1840s. Stage 1. Ireland's 8 million people depended entirely on potatoes. Cheap, abundant, taken for granted. Wheat is unnecessary. Stage 2, 1845. Potato blight from North America spreads across Ireland in weeks. 40% of the crop was destroyed in one season. Now, here's where it gets dark, and this is the key lesson for silver. Stage 3. By 1846, the British government understood this was a multi-year collapse. But here's the twist. Wheat was available, grain existed, but prices spiked so violently that the poor couldn't afford it. Physical shortage created price dislocation so extreme that available supply became inaccessible. Stage 4, 1 million dead, 2 million fled. Ireland's population collapsed 25%. Wheat prices stayed elevated for years. The market didn't fail because there was no food. It failed because price destroyed purchasing power faster than relief could arrive. Remember that. Palladium 2000's more recent, more financial. Stage 1. Throughout the 90s, cheap, boring, ignored by investors. Stage 2. Early 2000s. Emissions regulations tightened globally. Palladium became preferred for catalytic converters. Demand surged. Problem? Palladium is a byproduct. You can't just mine more. Supply equals structurally inelastic. Stage 3. By 2019, 8 consecutive years of deficit. Inventory is gone. Russia supplied 40% with no incentive to flood the market. Paper contracts tried to manage it, but physical markets decoupled. Stage 4, $500 an ounce in 2016 to $3,000 by 2020, 6 times in 4 years. The only correction came when automakers substituted platinum at massive cost and efficiency loss. When physical supply can't meet industrial demand, price is the only adjustment, and it's never smooth, it's violent. Now, let's apply this exact mechanism to silver. Stage 1, complacency. For 40 years, silver has been absurdly cheap. In inflation-adjusted terms, silver today costs less than 1980. 45 years of monetary expansion, industrial growth, tech revolution, and silver is cheaper. Why? Decades of supply exceeding demand, massive deposits developed, the government sold reserves, everyone treated it as boring. Complacency total. Stage 2. Inelastic supply meets surging demand. In 2010, solar installations were negligible. Today, solar is the fastest growing energy source globally. Every crystalline silicon panel requires silver paste. No substitute matches efficiency. The math. Every megawatt needs approximately 20 grams of silver. The IEA projects 400 plus gigawatts annually by 20 to 25. That's 200 million ounces per year for solar alone. Add electric vehicles, they use twice the silver versus gas cars. Add 5G infrastructure, medical devices, electronics. Industrial demand, 1 billion ounces per year. Global mine production peaked at 880 million ounces in 2015. Now, flat to declining. Why? I'll explain, but first understand this. 70% of silver is a byproduct of zinc, lead, and copper mining. You can't just mine more silver. You mine base metals and hope silver comes with it. Base metal prices are choppy. Mining capital expenditures at multi-decade lows, no new supply coming, zero. Supply equals inelastic. Demand equals exponential. Stage 3, recognition of deficit. We are here right now. This is happening in real time. In 2020, the COMEX had 400 million ounces of registered silver. Today, under 60 million ounces. 60 million ounces equals less than 3 weeks of global consumption. The Silver Institute confirms 3 consecutive years of deficit. Physical premiums rising, delivery times extending. The paper market, 100 ounces of paper silver traded for every 1 ounce physical, is losing control. We're watching registered inventories drain in real time. Industrial users are stockpiling because they see what's coming. This isn't temporary tightness. This is a structural multi-year supply crisis with no solution. Stage 4, panic. Not here yet, but close. What does the next phase look like? A major industrial player, solar manufacturer, defense contractor publicly announces they cannot source enough silver. That triggers the cascade. Other firms panic buy. Governments secure supply for strategic industries. Investment demand explodes. The paper market breaks. COMEX changes rules and restricts delivery, forces cash settlement. It's happened before. It will happen again. When physical decouples from paper, when the industrial bid meets the monetary bid, when solar panic combines with currency crisis, silver won't rise steadily. It will gap $50, $75, $100. These aren't predictions. These are the logical outcomes of supply-demand math in a market with no inventory buffer. But this time is different. Technology will save us. Let me destroy that delusion. Substitution, no substitute for silver and solar. Maintains efficiency at scale. Copper oxidizes. Aluminum doesn't conduct well enough. You cannot engineer around the periodic table. Recycling recovery rate from electronics is below 20%. Too small per device to be economical. Solar panels last 25 years. That silver isn't coming back soon. New mining takes 7 to 10 years to bring a mine online. We don't have 7 years. The deficit is now, and silver grades are declining globally. Demand destruction. The only way demand falls is if the energy transition stops, and the transition is mandated by law across Europe, China, and the United States. Trillions in subsidies committed, entire industries retold. This is policy. And policy doesn't care about silver prices. American exceptionalism will save us. Remember the 1970s, the most powerful country on earth, reserve currency, largest military, was brought to its knees by an oil embargo, gas lines, double-digit inflation, a decade of stagnation. Power doesn't exempt you from physics, from geology, from supply and demand. Silver isn't a policy tool. It's a finite element we're consuming faster than extracting. When that imbalance hits a critical threshold, price adjusts violently. Here's what you need to understand. The pattern I've shown you is not theory. It's historical fact repeated across commodities, time and systems, complacency, inelastic supply, recognition of deficit, panic, oil, wheat, palladium, now silver. The machine is the same. The outcome is the same. The only question is, do you see it before everyone else? Silver sits at the intersection of three unstoppable forces. The energy transition consumes silver exponentially. The monetary crisis driving investors to hard assets as fiat currencies debase. And the supply crisis with no solution in any time frame that matters. When these converge, and they're converging now, the price won't rise. It will dislocate. I'm not telling you to sell everything and buy silver. I'm not giving financial advice. What I'm showing you is simply pattern recognition. Once you understand how the system functions, you can't ignore it. So here's my request. Go verify everything yourself. Check global silver inventories. Look at the IEA's solar demand projections. Read the Silver Institute's supply-demand data. Study mining output reports. All of it is publicly available, and all of it is measurable. When you see inventories shrinking, deficits widening, and demand rising, you'll realize this isn't exaggeration. It's arithmetic. Math doesn't bend for opinions, politics, or optimism. When consumption surpasses production and stockpiles run dry, prices are forced upward. There is no alternate ending. And if you want to understand how we reach this point, how the financial system kept silver prices artificially low through paper markets who gained from suppressing its real value, and what happens when that structure finally breaks, watch the next video. Silver price control isn't speculation, it's recorded history. And the tools used to manage the price are failing right now. Subscribe and turn on notifications because what's coming is the largest shift in commodity wealth in half a century. Those who recognize the pattern and act before stage 4 will be positioned on the winning side. Everyone else will be left wondering how they overlooked it. Don't be one of them.